This video is about CPI. Hello, I'm Peter Martin with Trading 212 and I'm going to explain a little bit about CPI, the Consumer Price Index, what it is, why it's important. And when the cost of things rise, that is the price of goods and services, we call it inflation. You're probably familiar with that. And the economy tends to like a little bit of inflation, and I'll explain why in just a moment. But too much inflation can cause all sorts of problems. In the past, when inflation runs too high, it has been known to initiate downturns in the economy, to create or contribute to recessions. And because of that, policymakers and traders and economists like to keep a close eye on what's going on with inflation. Now, in one of my other videos about GDP, I explained about price deflators, and you can view that video by clicking on the subscribe button and subscribing to our YouTube channel. Now, the Fed likes to look at price deflators, which is just a type of gauge of inflation. But the trouble with that for traders is that the GDP report comes out on a quarterly basis and it's not that timely. So traders prefer a more timely look at inflation. So they tend to look at, for the US, the CPI report and the PPI report. The CPI report, as I said, is the Consumer Price Index, and the PPI is the Producer Price Index. Now in this video I'm just going to concentrate on the Consumer Price Index, which gauges price changes at a retail level, at the demand side, whereas Producer Price Index, as the name suggests, tends to look at the wholesale side, the producer level. And the US, the CPI report comes out on a monthly basis, roughly speaking around the middle of the month. It's released at 1:30 p.m. UK time, and it tends to be considered one of those reports that is potentially market moving. The CPI measures changes in price of goods and services at the consumer level, and it attempts to look at items that would be typically bought on a monthly basis. Traders focus on percentage changes in the CPI, either month over month or year over year. One particular area of focus is the cost of goods and services excluding food and energy, which we refer to as the core CPI. Now, the prices of food and energy can be volatile. They can change erratically according to things like geopolitical headlines, according to the weather. And so by excluding the price of food and energy and by looking at the core CPI, it's easier for economists and traders to spot inflationary trends. Now, we said before that the economy likes a little bit of inflation, and it is a bit of a balancing act. Too much inflation or too little inflation can be damaging to the economy. If we consider when the economy is strong, the demand is strong, then it allows corporations to respond to that demand by charging higher prices, which boost corporate profits, and that allows higher capital spending, which tends to create jobs. But if we get too little inflation, then the reverse is in play. It means that corporate profits are hurt, capital spending is hurt, and we get unemployment. But if we also consider high inflation or too high inflation, that puts a squeeze on the consumer. The consumer can't buy everything that they want. They have to start to make choices about what they're going to spend their money on, and that will put a drag on the economy, and eventually you get pretty much the same outcome as you did with too little inflation, which is unemployment. That said, CPI doesn't tend to be considered as a leading indicator. It hasn't historically had great predictive powers in relation to changes in the business cycle. But as we said before, it is considered to be potentially market moving, and it tends to have the most effect on the bond market. And this is because inflation erodes the purchasing power of coupon payments that bondholders receive. So if we get higher inflation, the bond market can be very sensitive to this, and the bond market will sell off in response to higher inflation, all other things being equal, generally speaking. But it can also have an effect on the stock market. We said that the Fed tends to prefer to look at the GDP deflators, but it goes without saying that if you are seeing a consistent message month over month in the CPI report, that is going to have implications for the path of monetary policy, which in turn has implications for the economy as a whole. Well, I hope you enjoyed this video about CPI. If you did, please hit the thumbs up button and give us a like. And don't forget, we upload new videos on a regular basis. If you click on the alarm bell icon, then you'll get a notification the next time we add a new video to YouTube. But that's all for this time from me, Peter Martin, and Trading 212. Thanks for watching. Goodbye.